And get to the big picture now and welcome in Joe Mazzola, head trading derivatives strategist over at Charles Schwab. Okay, very good morning to you, Joe. So we got some retail sales, a bit disappointing on the headline with a muted number over in December. Appetite for bonds this morning, we've got the 10-year at 414. I believe that's a one-month low. The DXY's pulling back, obviously. We've seen some regional currency strength. We know the story there. What does this mean as far as some of these GDP estimates in the Fed now?
Well, what's interesting is markets are pricing in maybe 3/4 cuts in 2026. It might be a little bit aggressive. Remember, this is a little bit old data. It's December data. We're still kind of compiling everything that we need for January, so that'll take some time to get that out. I think what's interesting to me is just maybe the slowdown in the consumer, maybe some pessimism around job growth or lack thereof, right? And what drives purchasing, right? What drives purchasing of big ticket items? A lot of it has to do with feeling, the comfort and the safety and your ability to maintain your job or find another job out there. And while we're not seeing unemployment rates climb higher, we're kind of stuck in this mud, if you will, the sticky little mud where there's not a lot of growth. There's not a lot of firing. There's not a lot of hiring. It's just kind of stuck in the mud, like I said. So I think that's weighing on consumers a little bit, causing them to maybe pull back on some of their, bigger ticket items. And if you look at, where we did see the pullback, it was in clothing, it was in auto parts. So I think it all kind of trickles down. Now, where does that leave the Fed? I think that leaves the Fed in a little bit of a tricky position because, like I said, I think with markets pricing in 3 cuts, is the Fed now transitioning from slowing down what we consider at one point, or what they considered at one point, an overheated economy? And where's that inflection point, right? Where's that inflection point where they need to start stimulating growth because of a slowing job market? It's going to be hard for them to kind of pick that exact point. So I think, as anything, Sam, they're going to wait for more data to come out before they make that final determination.
Yeah, but for now, at least, we're seeing the 2s, 10s and 30s all dipping this morning. Talk to us about the state of this rotation trade. Obviously, we've seen another record for the Dow this morning. The IGV is up, which is encouraging, particularly off the back of what we've seen in recent weeks. It looks like names like ServiceNow, Workday, AppLovin, all higher today, which I suppose is, as I said, what you want to see after the damage. But have you got any thoughts on what we're seeing as far as what's working, what's not working, and the state of this rotation trade that we've been talking about?
Yeah, before I got on the show, I kind of looked at the spread between performance in the chips versus the software, and that's the widest we've seen in multiple years. So part of it could be a catch-up trade. I think that makes sense. I think that there's oversold conditions in software. We were looking at the RSI, and on Friday, that got to a point where the RSI was around a 14-15. We haven't seen levels like that since, all the way back in 2002. So this is, through the great financial crisis, through, the pullback of 22 in the tech sector, it had just really gotten oversold. So I think that there's definitely some catch-up trade there. What I do think is important, though, is to look at the fact that we haven't set any new all-time highs in the Mag 7 really since October. The fact we haven't set a high in the NASDAQ 100 since October, but we continue to do so. I think 13 of them in the Equal Weight Index, So, yeah, the rotation trade, it's real, Sam, and it continues. And I wonder at some point, and this is, my own personal guess, is whether or not you can get a new all-time high overall in the S&P 500, not necessarily in the Dow, but in the S&P 500. If you don't have communication services, you don't have tech participating. We're seeing that come back a little bit over these last couple of days, but I think you need to see a bigger thrust there.
Ben Emmons from FedWatch Advisors was out with a really interesting note this morning about sort of the short-term memory loss in these markets. And, what he was alluding to was how in recent weeks, borrowing was not acceptable. I mean, we've seen that in Oracle with some of the concerns around tapping the debt markets, that debt-to-equity ratio. But now, all of a sudden, you've got this headline around Alphabet Google with this report of $20 billion bond sale, selling sterling and the Swiss franc denominated bonds for the first time. So they're looking at a lower cost of capital. Then you had this story about Oracle last week looking for more money. And obviously, the ratings agencies seem to be okay with that. So we saw a nice rally. Not to mention, when you look across the bond market, I mean, you've seen Japan having to come out and say, okay, we're going to be responsible and proactive with our fiscal spending this year, and then the yen strengthens, it doesn't weaken, which is the opposite of what the Takaichi trade is characterized by. What do you make of this shift as to how the market is thinking about debt right now, Joe? I don't know if you have any thoughts on that.
No, I do. Well, specifically, maybe not with the JGB, but specifically with Oracle versus Google. I think there's a difference in terms of balance sheets, right? Positions of strength versus weakness. Not to say that Oracle has a weak balance sheet, but the cash flow that Google has generated puts them in a position to where they can go and get fairly strong yields, or fairly good pricing for their debt issuance. So I think we're kind of transitioning away from using cash for all the AI spend, and I think companies now are recognizing that there's a separate market out there where they can generate those funds that they need without having to pay too high of a premium price. I mean, look, the takedown on those markets has been pretty fantastic. So they're not having any issues finding the financing, and they're doing it at a weighted average cost of capital that makes sense for these companies.
Yeah, it's interesting how Michael Burry, I think, has drawn comparisons to Motorola. I caught that headline, something to keep an eye on, but certainly interesting in the face of all this CapEx. Joe, really appreciate your insights. Thanks so much for joining me today. Joe Mazzola there, head trading and derivatives strategist over at Charles Schwab.